Hello, and welcome to the second video of the series, Fundamental of Partnership Accounting. And in this session, we will talk about treatment of capital and treatment of drawings. So let's begin with treatment of capital. Before we do a deep dive and understand how to manage partners' capital account for a partnership firm, let's understand a couple of terms. The first term that we need to understand is capital. What is capital? So as you know, capital refers to the amount that owner of a business, the sole proprietor or partner, invests in the business. And the amount invested by the owner of the business is known as capital. Interest on capital. When the partner has invested some amount in the business, then in order to give an incentive to the partners who or the owners who have invested some amount in the business, or a return that is provided to the owners for the amount invested in the business, is known as interest on capital. Appropriation of profit. The literal meaning of word appropriation is setting money or funds aside for a specific purpose or is transferred to a specific account. In simple words, we can say distribution. Hence, appropriation of profit means distribution of profit among partners or allocating share in profit to various partners. The next term that we will discuss is divisible profit. So the profit that is available for distribution or appropriation among the partners after making all the adjustments is termed as divisible profit. So later on in this series, when we will talk about distribution of profit among partners, or the preparation of profit and loss appropriation account, then this term divisible profit will become more clear to you. In that section, we will discuss that what are the different types of adjustments that we do with the net profit disclosed by the profit and loss account, and how we arrived at the figure of divisible profit. For now, you can just understand the profit which is available for distribution among partners or appropriation among partners is known as divisible profit. Effective employed capital. So there may be scenarios when partner starts the business by contributing a certain amount in the business, but at a later stage, depending on the situations and circumstances, partners may invest some additional amount of capital in the business, or he may even withdraw a part of capital which has already been invested in the business. So the amount of capital available for use by the business at a given point of time is termed as effective employed capital. Now, if we talk about what are the various methods of maintaining partners' capital account in a partnership firm, then there are basically two methods of maintaining partners' capital account in a partnership firm. First one is fixed capital account, and the second one is fluctuating capital account. Before we proceed further, let's take a pause and try to understand what is fixed capital account method and what is fluctuating capital account method of maintaining partners' capital account in a partnership firm. So when the partners' capital accounts are maintained using the fixed capital account method, then the partners' capital account balance will change only when there is a change in capital contribution by the partner. It means, for example, A, B, and C are three partners in a partnership firm, and A has contributed 50,000 rupees as initial investment in the partnership firm. But at a later stage, he contributed 40,000 more. So now in this case, the balance of the opening balance or the initial balance of A's capital account would be 50,000 and the closing balance of A's capital account would be 90,000. That is 50 plus 40. If similarly, B has made a contribution of 50,000 and he never added any amount further. So his balance of his capital account at the beginning and at the end would remain 50,000. Whereas if we talk about C, the partner C has initially invested 50,000 and at a later stage, he withdrew 20,000 from the firm from his share of capital. So in case of C, the opening balance or the initial balance of his capital account would be 50,000, but the closing balance would be 30,000. That is 50 minus 20,000. So in this case, there is change in partner's capital account balance for partner A and partner C. But these changes were not because of any other transaction, but purely because of change in the amount of capital contributed by these partners. Whereas if we talk about fluctuating capital method, then in this method, the balance of partners capital account may change even without any change in the amount of capital contributed by the partner. So if, again, taking the same example of partner A, B, and C, and all of them has contributed 50,000 each as their share of capital in the partnership firm, and none of them has added any capital or introduced any further capital or has withdrawn any part of their capital contributed, but still the balance of their capital account will change on account of interest on capital, interest on drawing, share in profit, and other such transactions. So we will discuss it in detail in subsequent slides, so it will become more clear to you. Now, if we do a quick comparison, so the first comparison is on the basis of meaning the capital account whose opening and closing balance remains unchanged is called fixed capital account. And if we talk about fluctuating capital method, the capital account whose balance goes on changing is known as fluctuating capital account. Number of accounts maintained for each partner. So if you are maintaining the partner's capital account using the fixed capital method, then for each partner, you will have to maintain two separate accounts. That is partner's capital account and partner's current account. Whereas under fluctuating capital method, you need to prepare only one account for each partner, and name of that account would be partner's capital account. Changes in balance of capital account. The balance of capital account changes only and only when there is introduction of additional capital or withdrawal of a portion of capital. And this withdrawal of portion of capital is other than drawings. So in the subsequent slides, we will discuss about what is drawings. Otherwise, the balance of partner's capital account remains fixed. Whereas in case of fluctuating capital method, the balance keeps on changing on account of various other transactions in addition to addition or withdrawal of capital. So in case of fluctuating capital method, if you are maintaining the partner's capital account using the fluctuating capital method, then the balance of capital account will not only change because of introduction of additional capital or withdrawal of a portion of capital, but on the because of some other transactions as well. Adjustments. No adjustment regarding salary, interest, and commission are made to the partner's capital account. Whereas the adjustments regarding salary, interest, or commission are made in the partner's capital account. Capital balance. The balance of capital account will always remain positive or credit. It will never have a negative or a debit balance. Whereas if you are maintaining the partner's capital account using fluctuating capital method, then the balance of capital account may go negative or it may have a debit balance as well. Presentation in balance sheet. When the partner's capital account is used, maintained using the fixed capital method, then both the accounts are shown separately in the balance sheet. The balance of capital account is shown on the liability side of the balance sheet because it will always have a credit balance. The balance of current account is shown in the liability side if the balance is credit, and it is shown on the asset side if the balance is debit. Whereas in fluctuating capital method, the balance of capital account, if it is credit balance, will be shown on liability side in the balance sheet and will be shown on the asset side if it has a debit balance. So the primary difference is under fixed capital method, you will have to show two accounts for each partner, that is partner's current balance of partner's current account and balance of partner's capital account in the balance sheet. Whereas under fluctuating capital method, only one account, balance of one account for each partner needs to be presented in the balance sheet. If we talk about recording of transactions, then under fixed capital method, in capital account, transactions related to additional capital brought in by the partners or withdrawal of capital other than drawings is recorded in partner's capital account. Rest all the transactions related to interest on capital, interest on drawings, commission, salary, share in general reserve, share in goodwill, share in profit or share in loss. All these other transactions are recorded in partner's current account. Whereas if you are maintaining partner's capital account using fluctuating capital method, then all the transactions are recorded in one account of the partner, that is partner's capital account. Moving further, at times we may land up in a situation where we need to calculate the capital at the beginning or the opening balance of capital account. So when in question, you are provided with the closing balance of capital account, you can simply use this formula to calculate the opening balance of capital account. All the items which were debited to partner's capital account or partner's current account would be added, that is drawings, interest on drawings, capital withdrawn during the year, and loss, if any, debited to partner's capital account. And remember this, if you are maintaining partner's capital account using the fixed method of capital, then only capital withdrawn during the year would be added back. That's why it has been highlighted in a different color or it is written in a different color. And all these four items, that is drawings, interest on drawings, capital withdrawn during the year, and loss, if any, debited to capital account, all these four items would be added to partner's capital account only if you are maintaining partner's capital account using fluctuating method of capital. Similarly, if the partner's capital account is maintained using fluctuating capital method, then profit, interest on capital, salary, if any, or commission, if any, or any additional capital introduced by the partner during the year, all these items would be deducted from the closing balance. Again, remember, if you are maintaining the partner's capital account using fixed method of capital, in that case, only the additional capital introduced by the partner during the year would be deducted from the closing balance of capital account. Rest of the items would be posted in the current account. So obviously these items will not have any impact on the closing balance of capital account. With that, let's move on. Appropriation of profit according to the capital ratio or effective capital ratio, what we have discussed earlier. In this method, the divisible profit is appropriated or distributed among the partners in the ratio of their capital employed in the firm during the accounting period. And why it is required? Because at times what happens is uh, as per the partnership deed, we need to provide interest on capital, we need to provide salary, we need to provide commission, and the profit is shared in an agreed ratio. But after taking all the transactions in consideration, the divisible profit, the profit which is available for distribution among partners, is not sufficient enough to meet all these charges or all these appropriations against profit. So in that case, we distribute the profit, or we do the appropriation of profit in the capital ratio. So for this, the opening and closing balance of partners account may be different, and partners may have brought in additional capital or may have withdrawn some part of their invested capitals during the accounting period. Or considering the above two factors, in order to arrive at the correct ratio in which the profit will be distributed among the partners, using the capital ratio, effective or employed capital needs to be calculated. And how it is calculated? Let's see. The total effective, to calculate the effective capital or employed capital, we can use the following formula. That is amount of capital employed multiplied by number of months. Here, amount of capital employed means the amount of capital available for usage by the firm. And number of months, months for which the amount of capital will be used by the firm. It is calculated by finding out the difference between the month in which there is a change in capital and the last month of the accounting period. If there is no change in capital contributed, then the opening balance of the capital account will be multiplied by 12 to calculate the effective capital or employed capital. Now, let's go through this example. A, B, and C started a business in partnership. A contributed rupees 50,000 for the whole year. B introduced 40,000 at first and increased it to 46,000 at the end of 4 months, but withdraws 16,000 at the end of 9 months. C invested 80,000 at first, but withdraws rupees 20,000 at the end of 5 months. So here you can see that A, B, and C, three partners, have contributed different amount of capital initially, and at a later stage, B and C made some changes or some adjustments in the amount of their capital contribution at a different phase. That's first part of the question. The second part of the question is, firm earned a profit of rupees 23,750 during the year. Distribute the profit among the partners basis the effective capital employed by each partner during the year. Now, this 23,750 needs to be distributed among these partners in the ratio of their capital employed. So for that, what we will do is we will calculate the effective capital employed. So for A, the calculation is very simple because there was no change in the amount of capital contributed by A. So we have multiplied 50,000 by 12 months, because for the entire 12 months, the contribution of capital by A in the firm was rupees 50,000. For B, initially B introduced 40,000 and then increased it to 46,000 at the end of 4 months. So what we have done is, for first 4 months, we have multiplied 40 by 4. Then the capital of B was increased to 46,000 and it remained at 46,000 for next 5 months, because at the end of 9 months, he withdrew 16,000. So 46,000 was multiplied by 5, and for rest of the 3 months of the accounting period, the capital employed by B in the firm was only 30,000. So we have multiplied 30,000 by 3. Whereas in case of C, C has initially invested 80,000 in the firm and which remained in firm for 5 months. And at the end of 5 months, that means from 6th month onwards, the effective capital employed by C in the firm was 60,000 only. So we have multiplied 60,000 by 7. So here we have got the products, that is 6 lakhs for A, 4 lakh 80,000 for B, and 8 lakh 20,000 for C. Now, what we have done is we have done the calculation of capital ratio, or we have calculated the ratio in the ratio of effective capital employed, which comes out to be 30:24:41. Now, if we do a sum of 30 plus 24 plus 41, that comes out to 95. And then we have distributed 23,750 in the ratio of their capital employed. So for A, he will get 30. For B, he will get 24. And for C, he will get 41. And all these are divided by 95. That is sum of all the ratios. So this is how you can calculate the effective capital employed, and this is how you can distribute the profit in the ratio of employed capital or effective capital employed by the partners in the firm. Now we will talk about treatment of interest on capital. Now the interest on capital can be treated as either charged against profit, or it can be treated as appropriation of profit. Now, what is charged against profit and what is appropriation of profit? As again, remember, the way profit is treated or the way profit is distributed among the partners depends on the provisions of partnership deed. So if the partnership deed provides that the interest on capital will be charged, will be treated as a charged against profit, that means interest on capital provided will be shown in the profit and loss account. First of all, here also remember, full interest on capital will be provided even if there are no sufficient profits, or even after even if there are losses, or even after charging or providing for interest on capital, the firm runs in losses. That's fine. But if the partnership deed provides that the interest on capital will be treated as a charge against profits, so no matter whatever the situation is, the firm is bound to provide interest on capital to the partners. And as discussed in point number 2, if the profits are not sufficient to provide the entire amount, say for example, the profit of the firm for a particular accounting period stands at rupees 10,000, and the total of amount that needs to be distributed or that needs to be provided to the partners as interest on capital stands at rupees 12,000, then this deficit of 2,000 will be borne by the partners in their profit sharing ratio. And this will be debited either to the partners capital account if we are maintaining the partners capital account using the fixed capital method, or to partners capital account if we are using the fluctuating capital method, and to partners current account if we are using fixed method of maintaining partners capital account. On the contrary, if the interest on capital is treated as appropriation of profit, then first and foremost thing is the interest on capital will be accounted for or will be treated in the profit and loss account, profit and loss appropriation account, and not in profit and loss account. The interest on capital would be restricted to the amount of profit earned. So again, going back to the same example, that The total interest on capital that needs to be provided is 12,000, and the firm has earned a profit of rupees 10,000 only. Then the partners will get interest on capital. The total interest on capital that would be provided to all the partners would can go maximum up to rupees 10,000. So in this case, the 2,000 deficit will not be charged to the partner's capital account or partner's current account, as the case may be. So the total interest on capital would be provided only up to rupees 10,000. If the profits earned is less, then the amount of interest on capital, the available amount will be distributed in ratio of interest on capital, that is appropriation ratio. So on the subsequent slide, we have discussed all these different scenarios. So you will understand what is the appropriation ratio. It is more or less just like what we have discussed on the previous slide. So this is these are the two scenarios how the interest on capital can be treated. This can be treated as charged against profit, or it can be treated as appropriation of profit. Now, on this slide, we have presented the summary of how the interest on capital is treated. So the first scenario is in absence of partnership deed, or the partnership deed is silent about interest on capital. This is our first scenario. When there is no partnership deed, or the partnership deed is silent, that means there is no mention of at what rate the interest on capital needs to be provided to the partners, or whether the interest on capital needs to be provided to the partners or not in the first place. So in this scenario, no interest on capital would be allowed to the partners. This is first scenario. The second scenario, second scenario is the provision. There is a provision for interest on capital in the partnership deed. Okay, but it is silent about treating the interest on capital as charged against profit or treating it as appropriation. So the partnership deed says that yes, we will provide interest on capital at the rate of 12%. But the partnership deed is not clarifying that whether it will be considered as a charge against profit, or the interest on capital would be treated as an appropriation. Then what will happen? According to the Section 13 of Partnership Deed Act of 1932, interest on capital will be allowed only if there is profit. That is first. Second scenario. If there is loss, no interest on capital will be provided. If the profit before interest on capital is less than the interest on capital, same thing. The total interest on capital needs to be provided is 12,000 and the profit is only of 10,000. Interest on capital will be restricted to the amount of profit, and this will be distributed in the ratio of interest on capital. So again, this ratio of interest on capital we will discuss on the following slides, when we will take up all these scenarios one by one in detail. If the profit before interest is equal or more than the interest on capital due to the partners will be allowed. That means the profit, the total capital interest on capital that needs to be provided is 12,000, and the profit is either 12,000 or more than 12,000, then full interest on capital will be provided. So that means we can sum this second scenario up in like this, that if there is provision on interest on capital in the partnership deed, but it is silent about treating the interest on capital as charged against profit or treat it as an appropriation, then we will treat this as appropriation. Now, if the partnership deed provides for treating the interest on capital as charged against profit, that means partnership deed is very clear. We will provide interest to the partners on their capital at a rate of 12%, and this interest on capital will be treated as charged against profit. Then the interest would be provided to the partners on the capital no matter whether there is sufficient profit or even losses. So if the total interest that needs to be provided on capital is 12,000 and the profit earned by the firm is 10,000, then also the interest on capital would be provided to the tune of rupees 12,000, and the deficit of 2,000 would be charged to partner's capital account or current account as the case may be. If the partnership deed provides to treat interest on capital as appropriation, then what will happen is the interest on capital would be provided only if there are profits, or if the profit is not sufficient enough, then the amount of interest on capital would be restricted to the amount of profit. So now let's look at these scenarios one by one. First scenario: in absence of partnership deed, or the partnership deed is silent about interest on capital treatment, no interest on capital would be provided, and the divisible profit, that is net profit after making other adjustment and appropriations, would be distributed among all the partners in the profit sharing ratio. So this is how it works. Here, this is our net profit transferred from profit and loss account. Then interest on partners drawing, which is 2,000. So the total divisible, of credit side is 12,000. Then there was provision that partners will be eligible to get salary, 1,000 each. Then commission paid to the partners, 1,000 each. Amount transferred to the general reserve. So out of this 12,000, 6,000 has already gone here. Now balance 6,000, that is distributed in the among both the partners in the profit sharing ratio. So here we are assuming that the partners are sharing profit and losses equally. So now here I would like to highlight one thing. We spoke about something called divisible profit. So 10,000 net profit plus 2,000 of income for the partnership firm on account of interest on partners drawing. So the total profit available was 12,000. And out of this 12,000, we have appropriated 6,000 to different heads, that is partner's salary account, partner's commission account, and general reserve. So after deducting this 6,000 from 12,000, the balance 6,000, which was available for distribution among partners as profit, that amount, that 6,000 is actually the divisible profit. So you in the net profit, we have made all the adjustment. That is, in net profit, we have added all the amounts that was due to the firm from the partners, and we have debited all the amounts, or we have deducted all the amounts that was supposed to be taken out from the profit before actually distributing the profit among the partners. So I hope now the term divisible profit is clear to you, and first scenario of treating the interest on capital is also clear to you. Let's move on. Scenario 2 and 3. There is provision for interest on capital in the agreement, but the agreement is silent as to the treatment of interest on capital as a charge or appropriation, and there is no profit or loss during the accounting period. So here, two things. First, the partnership deed has clearly mentioned that the interest on capital would be provided, but the partnership deed has not made it clear that it would be considered as a charge or appropriation. That is number one. And the second thing worth noting is there is no profit, or the firm has suffered loss during the accounting period. Then in that case, no interest on capital would be provided, and the divisible loss, that is net loss after making other adjustment appropriations, will be distributed among all the partners in the profit sharing ratio. So this is how we will treat this. Net loss transfer to profit and loss account 6,000, and the 6,000 is distributed among both the partners in equal ratio, that is 3,000 each. So in scenario 2 and 3 of our previous slide, This one, you can refer back to here, these scenarios, okay? First scenario we have discussed, scenario 2 and 3 we have just discussed. Now we will talk about scenario 4. So in scenario 4, what we are going to cover is, there is provision for interest on capital in partnership deed, but it is silent about treating the interest on capital as charge against profit or treat it as appropriation. And if profit before interest on capital is less than the interest on capital, that is scenario 4A. Interest on capital will be restricted to the amount of profit, and this will be distributed in the ratio of interest on capital. So how this is going to happen? Let's assume there are three partners, partner A, B, C. The capital contributed, these partners are 1 lakh, 1,50,000 and 1,80,000. The rate of interest on capital is 12% per annum. So the interest on capital would amount to 12,000, 18,000 and 21,600. So the total interest on capital that needs to be provided is 51,600. Whereas the profit earned during the accounting period is only 45,000. So what we will do is we will distribute the profit in the ratio of interest on capital. Here we will not consider the profit sharing ratio of the partners. We will consider the ratio of interest on capital, and the ratio of interest in capital is 10:15:18. The total comes to 43, and this 45,000 is distributed among A, B, and C in the ratio of 10:15:18. If we talk about the next scenario, there is provision for interest on capital in partnership deed, but it is silent about treating the interest on capital as charged against profit or treat it as appropriation. And if the profit before interest on capital is less than the interest on capital, interest on capital will be restricted to the amount of profit, and it will be distributed in the ratio of interest in ratio of interest on capital. So this is how we have distributed the profit basis the calculations what we did on the previous slide. So this is how your profit and loss appropriation account should look like in regard to the interest on partners capital. Now moving on to scenario 5. Scenario 5 says that there is provision for interest on capital in partnership deed, but it is silent about treating the interest on capital as charged against profit or treat it as appropriation. And if profit before interest is equals to or more than the interest on capital, then interest on capital due to the partners would be provided. Here we need not to do any adjustment. So again, taking the same example, remember the profit before interest on capital is equals to or more than interest on capital. So same example, A, B, and C, their profit sharing ratio is 1, 2, 3. Their capital contributed is 1 lakh, 1,50,000, 1,80,000. Rate of interest on capital is 12% per annum. Interest on capital is 12,000, 18,000, 21,600. Total comes to 51,600. Here, the profit earned for the accounting period is 55,000, which is obviously more than 51,600. So whatever interest on capital is due, that is 12,000, 18,000 and 21,600, that would be provided. The balance amount, that is 3,400, that means 55,000 minus 51,600. The balance amount, that is 34,000, that would be distributed among the partners in their profit sharing ratio. So here now, for distributing the profit, we are considering the profit sharing ratio, that is 1:2:3, and not the interest on capital ratio. So please be careful about this. And If we talk about scenario 6, if the partnership deed provides for treating the interest on capital as charged against profit, then what will happen? If the interest on capital is to be treated as charged against profit, interest on capital would be provided, will interest on capital will be provided whether there is will be provided whether there is sufficient profit or even there is loss. Now, let's see this scenario again. A, B, and C are partners. This is the amount of capital invested. This is the rate of interest on capital, and this is the interest amount for interest on capital. But in this accounting period, the amount of profit is 4,560. And the interest on capital that needs to be provided is 51,600, which is 6,000 more than the profit earned by the partnership firm. But as per the partnership deed, the interest on capital needs to be treated as charged against profit. So what will happen is we will provide the entire amount of interest on capital due to the partners. So to A, we will pay 12,000 as interest on capital. To B, we will pay 18,000, and to C, we will pay 21,600. But there is a deficit of rupees 6,000. So this 6,000 would be distributed among the partners in their profit sharing ratio. That is 1:2:3. So for 45,600 of profit plus 6,000 that we have brought in from the partners capital account, that would be added to this amount, and we will make this amount as 51,600, and this would be provided to the partners as interest on capital. And in this scenario, the profit and loss appropriation account would look like this. So here we have got profit of 45,600. Then we have brought in another 6,000 from partners capital account. So this is contribution by partners for interest on capital. So the total comes to 51,600, and this 51,600 is distributed among the partners as their interest on partners capital account. So this total comes to 51,600. So we will do this only and only when the partnership deed provides for treating interest on capital as charged against profit, and the profit is not sufficient enough to pay the entire amount due to partners as interest on capital. And now the last scenario. The last scenario is if the partnership deed provides to treat interest on capital as appropriation. Then what we will do, if the interest on capital is to be treated as appropriation, interest on capital would be provided if there is profit, and the amount of interest on capital will, but the amount of interest on capital would be restricted to the amount of profit. Let's see another example. Here, partners are A, B, and C. This is the amount of capital contributed to them. This is rate of interest on capital. Interest on capital amount is 12,000, 18,000, 21,600. Total comes to 51,600. And the profit is only 45,000. So now this 45,000 would be distributed among the partners in the ratio of their interest on capital and not on the basis of their profit sharing ratio. So this 45,000 is provided to the partners as interest on capital. And your profit and loss appropriation account should look like this. So these are the different scenarios of treating the interest on capital account. Now, there are a couple of things that you should keep in mind. First, interest on capital is generally provided because of two reasons or in two scenarios: when the partners contribute unequal amounts of capital but shares profit equally. The second thing is where the capital contributed is same but the profit sharing is unequal. That means all the partners have, say for example, contributed 50,000 each, but their profit sharing ratio is different. The interest on capital is calculated with due allowance for additional or withdrawal of capital during the accounting period. So if you remember, when we are calculating the effective capital, right? So in that we have done some calculations in regard to how much capital was available in the firm for usage at any given point in time. So if the capital is the amount of capital contributed by the partners keeps on changing, then you must take those changes into consideration while calculating the interest on capital. Normally, the interest will not be allowed during the years when firms has incurred loss until or unless it is clearly specified in the partnership deed that the interest on capital would be considered as a charge against profit, and if it is considered as charged against profit, then it would be shown in the profit and loss account rather than coming in the profit and loss appropriation account. If in a year the profit of firm is less than the amount due to the partners as interest on capital, the payment of interest will be restricted to the amounts of profit. In that case, the profit will be effectively distributed in the ratio of interest on capital of each partner. This is also something we have discussed in detail. And if the interest on capital is to be allowed as per agreement, it should be calculated with respect to the time, rate of interest, and amount of capital. So these are a couple of points that we have already discussed, and this is just a summary or a refresher of the key points that you should keep in your mind. And for calculating the to calculate the amount of interest on capital, the formula that you can use is amount of capital multiplied by rate of interest on capital divided by 100 multiplied by number of months capital was employed in the business upon 12, the total number of months in a year. So for in any accounting period, we have got 12 months. So say, for example, if the partner has initially contributed rupees 50,000 as capital, and after 6 months he added another 20,000. So what we will do is we will calculate interest on 50,000 for first 6 months and interest for 70,000 for second part of the year for another block of 6 months. So that's pretty much about treatment of partners' capital or interest on capital. Now, the second topic that we are going to cover in this session is treatment of drawings and interest on drawings. So let's understand what are drawings. Drawings refer to the act of withdrawing cash or assets from the company by the owners for personal use. Here by owners, we mean the partners. Drawings can occur by withdrawing cash from the business account, but can also include anything that is considered a business asset, such as products or equipments that is removed from the business for personal use by the owners or the partners. So it is not necessary or it is not mandatory that the drawings can always be in cash. It can be in some other form also. Any type of drawing reduce the capital or owner's equity of a business. So it is important to keep a track of these drawings and manage them within your accounts. However, drawings are not considered as business expenses. Now, what are the types of drawings? There are two types of drawings, that is drawings against capital and drawings against profit. Now, when we talk about drawings against capital is when the drawings is made in excess of profit generated by the firm from its operations. Drawing against capital is part of capital, and drawings against capital is debited to capital account. when we talk about drawings against capital. What is drawings against profit? Drawings against profit refers to the situation when the owner withdraws funds from the company. The fund withdrawn is taken out of profit generated from the operations, that is sales, etc. And drawings against profit is part of expected profit, because during the financial year, till the time you have not closed your books of accounts, you cannot tell that whether your business entity is going to earn profit or it's going to suffer loss. And if it is going to earn profit, then what will be the amount of profit? But still, the partners or the owners make drawings against the anticipated profit. Drawings against profit is debited in drawings account and not in partners capital account. If we talk about these two types of drawings, the difference between drawings against capital and drawings against profit, the drawings is made out of capital, it may be known as part of capital, drawings against capital. Whereas drawings against profit, these drawings is made out of profit, it may be known as part of prospective profit. As I told you a couple of minutes back, that till that time you don't close your books of accounts, you are not sure whether you are going to earn profit or not. And if you are going to earn profit, then how much profit you are going to earn. So the drawings made against profit is against the prospective or the anticipated profit. Calculation of interest. This drawing is taken into consideration for calculation of interest. The drawings against profit is not considered for calculating the interest on capital. Accounting treatment. This drawings is debited to capital account, the drawings against capital, and the drawings against profit is debited to the drawings account. Effect on capital. The drawings against capital always reduces your capital, but the drawings against profit, it does not reduce your capital. There are a couple of things that you should keep in mind. Interest on drawings is not charged unless the partnership deed specifically mentions that interest on amount drawn by the partners is to be charged. Till that time, partnership deed is silent about whether to charge interest on drawings or not in the first place, and if yes, then at what rate interest would be charged on drawings. Till that time, you cannot charge interest on drawings. The rate of interest should be specified. Then in absence of any provisions as to interest on drawings, no interest on drawings will be charged. Interest on drawings is a gain for firm, because when the firm charges interest on drawings, the firm will receive the money from the partners, and interest on drawings is loss for the partners because this is something they have to pay to the firm. And interest on drawing is shown on the credit side of profit and loss appropriation account. Interest on drawing is recorded on the debit side of partners capital or current account, as the case may be. If you are maintaining the partners capital account using fixed method of capital, then it will appear on the current account. And if the partners capital account is maintained using fluctuating capital, then it would be in the partners capital account. There are few things you must remember. Interest on drawing is charged only on the amount of drawing which is earned from the partnership firm. It is not charged on the amount invested in the partnership firm by the partner. One should see in question that whether a specific mention is there that interest on drawings is out of amount invested in the partnership firm. In such a case, no interest on drawings is charged. However, in most of the questions, this is not mentioned. Hence, interest on drawing should be charged in those cases. So normally, the question is silent on this point, that whether it is the drawings is out of amount invested in the partnership firm or not. So we, in normal scenarios, we charge interest on drawings. Interest on drawings should be calculated from the date of withdrawal of amount and not for the entire year. In the absence of date of withdrawal, interest should be charged for 6 months on the whole of the amount, because it will be assumed that drawings were made evenly throughout the year. So if only the amount is given that the partner has withdrawn 10,000 rupees during the year, and the interest rate is 12%, then you will charge interest for 6 months on that entire 10,000, assuming that equal amounts were withdrawn throughout the year. When the rate of interest is given without the word per annum, interest will be charged without considering the time or date of drawings. In other words, interest would be charged for 12 months. So these are 3 key points that you should remember while calculating the interest on drawings. Now, if we talk about methods of calculating interest on drawings. So there are 3 commonly used methods of calculating interest on drawings. First one is simple method, the second one is product method, and the third one is average period method. So we will look at all these 3 different methods of calculating interest on drawings. The first one is simple method of calculating interest on drawings. Under this method, interest of drawing is calculated separately on each amount of drawing from the date of drawings till the close of accounting period. Formula used for calculation is amount of drawings multiplied by rate of interest upon 100 multiplied by number of months divided by 12. So here amount of drawings, the amount withdrawn from the firm by the partner for personal use, the rate of interest, rate at which the interest needs to be charged on drawings, number of months. This means a number of months for which the amount of drawings will be used by the partner. It is calculated by finding out the difference between the month in which the drawings are made and the last month of the accounting period. Let's look at an example. Charu is a partner in a firm. She withdrew the following amounts during the year ended on 31st March 2018, and the interest on drawings to be charged at the rate of 9% per annum. Calculate the interest on drawings. And for calculating the interest, we will use the simple method. So these are the amounts that are withdrawn by Charu on the different dates or different dates during the accounting period, and amount is also given. So first of all, what we will do is we need to prepare a table like this. And here what we are doing is we are calculating the interest on each amount withdrawn separately. So in the first case, Charu has withdrawn 20,000 on 1st of May. So as you know that our accounting period starts on 1st of April and ends on 31st of March in the following year. So that means if the amount has been withdrawn on 1st of May, then it would be used from by the partner from 1st of May till 31st of March, which comes out to be 11 months. So we have calculated interest on 20,000 at the rate of 9% per annum for 11 months, which comes out to 1,650. Similarly, the next amount was withdrawn on 31st of March. That means, 31st of July, which means 1st of August. So from August to March 31st, it comes out to 8 months. Then 30th September means 1st of October. So from 1st of October till 31st of March, it comes out to 6 months. Then 30th November, which means 1st of December. So from 1st of December till 31st of March, it comes out to 4 months. Then on 1st of January, so from 1st of January till 31st of March, it comes out to be 3 months. And 31st of March, that means on the last day of the accounting period. So we will not calculate any interest on this amount, which is of rupees 25,000. So we have calculated the interest for individual amounts for the individual periods using the simple formula of amount multiplied by rate of interest divided by 100 multiplied by number of months upon 12. And the total interest on drawings that Charu needs to pay is 5,250. Now, the product method of calculating interest on drawings. In product method, first of all the products are computed by multiplying the each set of drawings from its duration. Thereafter, the different products are added and the interest is calculated on the total of products. So arrived at for 1 month. The advantage of this system is that separate calculations are not required each time. Formula used for the calculation is total of products multiplied by rate of interest upon 100 multiplied by 1 by 12. Remember what we have just read, that on the products of all the on the total of products, we calculate the interest for 1 month. That is the reason here in the time period we are multiplying it 1 by 12, means we are calculating the interest for 1 month only. Now, product, the amount of drawings multiplied by the number of months for which the amount has been used. Rate of interest we have already discussed. Number of months we have already discussed. Now let's see how to calculate the interest on drawings using the product method. Same example, but here instead of using the simple method, we will use the product method. This is the same table, same data that we have used in our previous example. But now what we will do is, instead of calculating the interest separately for each withdrawal, we will calculate the product. And to calculate the product, what we will do is we will multiply the amount by the number of months. And number of months we have arrived in the same way. So the total of all these products is 7 lakhs. Now on 7 lakhs, we will calculate the interest at the rate of 9% for 1 month. And you see here, the amount still comes to 5,250. So no matter whether you are using the product method or simple method, you will get the same amount. The result would be same. Now, the third method of calculating interest on drawings is average method. So the average method of calculating interest on drawings can be applied only when two conditions are fulfilled. So the simple method and the product method can be used for calculating interest on drawings in any circumstance. But if you want to use the average method, then the two conditions must be fulfilled. The first one is all the amounts of drawings should be equal. So in the previous example, we have seen that in some month, Charu has withdrawn 2,000, then 20,000, 10,000, 25,000. So different amounts were withdrawn. So the first condition is not met. So in that case, we cannot use the average method. The second is the time gap between the drawings is equal. In the previous example, we have seen at times it was withdrawn on the first of the month, then at the end of the month, and then in some of the gap between the two drawings were either 2 months, 3 months, likewise. So the time gap between the drawings was also not equal. So in that case, we cannot use the average method. So average method can only be used when the amount of drawings are equal. That means equal amount of drawings, say 2,000, 5,000, 10,000, whatever the amount is. The amount of drawings are equal. That's first condition. And the second is the time gap between the two drawings is equal. So if the drawings are made on the first of every month, then every month the drawing should be on the first of every month, or at the last day of every month, or in the middle of the every month. So these are the two conditions which must be fulfilled to use the average method of calculating interest on drawings. And the formula that used is amount of drawings. So here you can take you will consider only one amount because all the amounts are equal. So even if a partner has withdrawn 20,000 rupees 4 times in a year, then we will consider only 20,000 for our calculation and not 80,000. Amount of drawings multiplied by rate of interest upon 100 multiplied by average number of months divided by 12. And what is this average number of months, that we will understand at a later in the following slides. And we have also provided with a table on subsequent slides because there are 12 different scenarios where you can use this average method, and for each scenario what will be the average number of months that you would use is presented in that table. Now, the first scenario is when the drawings are made on the first day or beginning of every month. The second scenario is when the drawings are made at the end of every month, or the third is when the drawings are made at the middle of every month or any time during the month. So these are the three scenarios when the drawings are made on a monthly basis. Then there can be three scenarios for quarterly drawings, and those three scenarios are same. When the drawings are made at the beginning of each quarter, when the drawings are made at the end of each quarter, or the drawings are made during the middle of the each quarter. The next is when the drawings are made only once in every 6 months at the beginning of the period, when the drawings are made only once in every 6 months at the end of the period. That means from April to September, that is first half of the year, and then October to March, that is second half of the year or the accounting period. So the drawings were made on 1st of April and 1st of October in scenario 7. In scenario 8, the drawings were made on 30th of September and 31st of March, or the drawings were made only once in every 6 months, anytime during the period. When the drawings are made for a period of 9 months, every month on the first day of the month, made in a period of 9 months, every month on the last day of the month, or during any time of that time block of 9 months. So these are the 12 different scenarios, and these are the average number of months. So if the drawings are made on the first or beginning of every month, the average number of months that we will use in formula is 6.5. End of the month, 5.5. Middle of the month, 6 months. Beginning of every quarter, 7.5. End of every quarter, 4.5. Middle of every quarter, 6 months. And similarly, for beginning of every 6 months, 3.5, end of every 6 months, 2.5, middle of every 6 months, 3 months. Beginning of 9-month period, 5 months, end of 9 months period, 4 months, middle of the 9-month period, 4.5 months. So the you will have to, you have no other choice but to memorize these 12 scenarios, and for each scenario you will have to memorize the average number of months that you have to use in the formula. Now, when the total amount of withdrawn is given but the date of withdrawals are not specified, it is assumed that the amount was withdrawn evenly throughout the year. For calculating of interest, the period would be taken as 6 months, which is average period, assuming the amount is withdrawn evenly in the middle of the month throughout the year. And the formula is amount of drawings divided by rate of interest, multiplied by rate of interest on drawings divided by 100 multiplied by 6 months. That is the average period divided by 12. So that's pretty much about treatment of capital and interest on capital, and treatment of drawings and interest on drawings. Now, we will publish another video in this series, and in that we will talk about other calculations and past adjustments. If you have any questions or comments, you can feel free to write to us. Thank you.